Past performance is no guarantee of future results. Content is offered for information purposes only. Unless stated otherwise, any and all individuals participating in the video are third parties that include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Unless stated otherwise, the views or opinions expressed may not reflect those of Seeking Alpha as a whole. The accuracy and completeness of content shared cannot be guaranteed. Seeking Alpha does not take account of your objectives or financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. Hey everyone, Daniel Snyder from Seeking Alpha. Welcome back to another episode of ETF Spotlight. Today, we have a true pleasure to speak with Jeffrey Sherman. He is the Deputy Chief Investment Officer at Doubleline. We're talking about the CAPE ETF, CAPE today. So let's go ahead and dive on in with Jeffrey. Jeffrey, thank you for joining us on the show.
Yeah, good morning, Daniel. Thanks for having me.
So let's start at the beginning. The CAPE ETF. How did this thing come to fruition, and what should investors just know about it from a high-level perspective?
Yeah, I think the most simplest way to think about it is that it's a sector rotation product that focuses on assessing value within the sectors of the S&P 500. So where a lot of traditional value products or value managers or even value strategies focus on building up value from the security selection basis, the CAPE ETF focuses on identifying value within various sectors of the market. And it does so by using the CAPE ratio that Professor Shiller invented along with his grad student, John Campbell, back in the seminal piece they wrote back in 1988. So this is not something new applying the CAPE ratio, but what has been novel about the approach that we've partnered with Dr. Shiller and Barclays on over the last decade plus is applying the CAPE ratio at the sector level of the S&P 500.
So for the people that are watching right now, a lot of us know Dr. Shiller, I mean, legend in our industry, but why the Shiller ratio over just something standard like PE ratio that a lot of newer investors kind of hear about?
Yeah, or adjusted ratios or performer ratios or whatever ratio makes the stock look attractive today, right? And that's a joke, of course. But Professor Shiller is rooted in academia, of course, being a Nobel laureate. But also, he's really went back and looked through the annals of history. And if you actually dust off these principles that really are the foundation for CAPE, they actually sit within Graham and Dodd. And so if you go back into their book back from the 30s, and if you look at what they said that you need to analyze companies through a cycle, not very short term, not the ADHD world we live in today or the TikTok world we live in, but actually assessing what a company looks like through the ups and downs of a business cycle. Now, to your point, Daniel, a lot of investors haven't really seen many cycles, right? Let's just say you were an investor that started in 2010. You really had one cycle till the pandemic, which was a very strange aberration, I would say. We had the pandemic and we've had the recovery. Now, some may argue with Liberation Day and things, they feel like there's been a cycle, but the idea is to look through the noise. And so what the CAPE ratio identifies is instead of looking at the short-term earnings in the denominator of that price earnings ratio, it uses a longer term viewpoint. So the one kind of nuance about that, if you're going to use a longer term assessment period for the earnings, you have to inflation adjust those as well, which now is back also on investors' minds again. So by using the CAPE ratio, applying it at the kind of like at the market context, applying it across various markets, it has one of the higher predictive powers in math speak. It's called the R squared of future returns. That said, it's not very good. If it was very good, we would all use it, and that would just be the end of the day. And so what you find is it has some of the highest predictive power. And by the way, its principles work across any type of portfolio where you can diversify out that idiosyncratic risk, and thus it works at the sector level.
So using this CAPE ratio and how this fund is put together, I mean, I'm looking here on Seeking Alpha today, the holding breakdowns, you're about split up in almost a quarter of each of it across communication, consumer defensive, real estate, consumer cyclical. So how does the actual fund use the CAPE ratio within the sector rotation of how the fund operates?
Well, that was pretty astute of you, Daniel, to recognize that it's about a quarter each because the process is focused on actually equally weighting across four sectors of the market. So the process is one with which what we do is this. At each month end, you assess the CAPE ratio of each sector of the S&P 500. So today's 11 sectors. You go back, you calculate those CAPE ratios. So that is the price today divided the last 10 years of inflation adjusted earnings for the entire sector. And this identifies the CAPE ratio of the sector. Now, what you find, Daniel, is that at some point you'll see that some sectors trade at multiples above other sectors throughout all of history. I like to use the example of technology versus something like utilities, right? People value a dollar of tech earnings more than they value a dollar of utility earnings. And so what happens there is that instead of just ranking the sectors based on their outright CAPE ratio, you actually make a small adjustment and you compare each sector's CAPE ratio to its own history. So you can think about it from a trader's perspective. It says, is this sector cheap or rich relative to its own history? And again, using this longer term framework, it tries to weed through a lot of the noise that you see in the day-to-day of markets. And then from there, you have 11 sectors. And so what you want to do is identify the cheapest. So on this relative ratio, the 5 sectors, which are indeed the cheapest, are the ones you want to put in your universe. Now, there's one kind of wrinkle in all of this is that, and a lot of value investors have learned this over the last decade. It's something that's been around in the academic literature for many decades, is that what happens when you buy valuation, something can be cheap, but it's also cheap for a reason, or it's cheap and getting cheaper. And so the academic way to kind of apply this kind of value trap filter is to apply momentum. And so instead of looking for the things with momentum, since you're focused on value, which is inherently somewhat mean reverting, what you're trying to do is throw away the sector with the worst momentum. So let me recap everything. So what you do is you take the 11 sectors of the S&P, you calculate this relative CAPE ratio, you rank them, the cheapest 5 of which you identify. Of the 5, whichever one has the worst 1-year total return, you get rid of that and you're left with 4 sectors. Then as you saw from the holdings, you've gotten equally weight those 4 sectors of the market. And so this isn't equally weighting all the securities, it's equally weighting the sectors. So you still have this market cap exposure. It's still a large cap portfolio, but it's a different take on applying value. And again, instead of building it from the security selection level, it's building value from the various sectors of the overall market. And that process is repeated each month. And so if there's no change in constituency from month to month, we go ahead and rebalance. If there is some sort of change in constituency, then we implement a trading window over a couple of days, and hence we use the methodology we do to protect those holdings.
Now, you've mentioned quite a few times that the ratio goes back throughout history. Maybe we can dive into how long that goes back, because I think nowadays specifically, everybody feels like the cycles are happening faster and faster. The spread of information, the quick correction of COVID or the Liberation Day. I mean, it feels like everything is immediately pull down, V-shape, shoot back up. Is this a different type of market? How can we compare this market to historical markets? Just kind of curious on your thoughts on that time in history and how things are evolving.
Yeah, well, this is where I like to tap into the brain of Professor Shiller. And, I've asked him this question over the last decade or so as we've done events together and we've sat on stage together. And it's always interesting because he goes back and he likes to talk about the great invention of his lifetime, microfilm, right? And so he goes back and talks about how, before the whole Google machines and AI, he actually went to the library and looked up the microfilm, but he's reading newspapers and these ideas that we hear about this time it's different, about, oh, the cycle's different, oh, the young generation doesn't want to work. Those are just simply narratives that permeate many different I'll call it many different eras. And so, yes, there is a difference in valuation today. And so, the critics of the CAPE ratio will say, well, you can't go back to 1871 like Professor Shiller does. It's a different world. But at the end of it, what you find is that instead of using, let's say the last, call it 150 years of data. Sorry, the country's only been around 250 years. Can't have 250 years of economic data. But the idea is that what you want to do is make sure that you have enough market data for all this. So by the way, these sectors didn't exist that long. So what we actually do in the CAPE ratio is that we make it more pragmatic. And so we're using 10 years of earnings in the denominator. We calculate that relative ratio. We're only using a rolling period of 20 years to compare that to. So it's only 30 years of data, to which Professor Shiller may scoff at times and say only 30 years. But I think that's pretty well encapsulating the cycle. And so again, for all these narratives that have permeated over time, discussing how this time it's different, how fast the cycles are, and you identify anecdotally two of them, the process is still one that's been able to identify value over at least the last 12 to 13 years.
Thanks for sharing that info. I think about the 30 years, and it's longer than a generation, right? And we think about how different people in the generation, participants of investors, go through different things. Wondering if you might be able to walk us through this verified intraday indicative value that the CAPE uses within the active share structure and how it incorporates in this fund.
Yeah, and so it's just like something that would be kind of like an iNav, where if you publish the holdings on a daily basis, everybody can see them, they can calculate on the fly. Our calculation agent will do that behind the scenes. But given that we use the active shares methodology to protect our intellectual property, and Professor Shiller's work that he's done over such a long period of time, that he uses this VIIV. The only difference an investor needs to know is that there's a portfolio. The custodian knows what the portfolio is. The authorized participants or the traders in the market don't know exactly what that portfolio is. Only our custodian does, and they're the ones who flash that VIIV. So given that technically the holdings aren't published out there, that's why it has a different acronym. That said, it starts to cause concern. Well, if there's not transparency, how does one trade it? What you'll find is that now we have over 3 years of trading history. You can go back and look at the premium and discount and realize that, again, because it's a large cap portfolio, because the holdings don't move meaningfully day to day, there still is the ability to make a pretty tight market. And by the way, the APs are pretty sharp on their overall pricing. And so they keep it very tight to that overall VIIV. So it's a different acronym out there. That's the beauty of finance. We love acronyms. We want them to sound sophisticated. But at the end of the day, it looks just like something that would be called an iNav, or the intraday NAV, on any other fund that's out there that publishes its daily holdings.
All right, thanks, Jeffrey. I wanted to ask you as well, because we're kind of curious at all times at how different ETFs are used within portfolios. So kind of curious, have you heard from any portfolio managers, institutions, and the like investors on how they incorporate CAPE into an overall maybe ETF portfolio, or just any kind of mixed bag, if you will?
Yeah. No, we partner with a lot of allocators out there. We run model portfolios for various TAMPs out there. We publish on some of these platforms as well. And so we think that CAPE is part of that overall suite for overall allocation. So how do people ultimately use it? They use it as a way of augmenting their large cap value exposure. For those out there, I know, again, value has been out of vogue, but if you compare CAPE to the value sectors of the market or the value indices, it's done extremely well, almost year in, year out. At times, CAPE, because it identifies sectors, may have a growthy component. That's why we index it against the S&P 500, which, like every other manager, has been difficult with this AI run over the last couple of years. But what you find is that people, they're looking for ways to supplement that kind of large cap beta that they have out there. And, with the amount of concentration in the S&P 500 within, call it the top 10 names, call it within certain sectors, how tech is like almost 33% of the overall market today. What you find is you're looking at different ways to diversify. And so we've sold investors over, at least my entire career, we've been taught the mantra: diversify, diversify, diversify. Here's this nice ETF that helps you diversify out, called the S&P 500. But now it's having more concentration risk. So I like to tell investors, well, you own that for having a one-stop shop for a ticker that gets you this diversity, but does it give you the diversity it used to give you? And so that's what we're having conversations with over the last year or two. And you've seen that in this year to date, the CAPE index and the CAPE ETF has done better than the S&P 500. And so there's been a lot of tracking here, of course, because of the liberation and the like. But what you find is that if looking at ways to kind of think on a go forward basis about portfolios and thinking about where valuation is, that's how we see people using it. So I think that, we've seen twofold. At one point, people thought of it as an S&P replacement. I've always said it's a value product. And thus, why wouldn't you not think about it as part of your value allocation? And furthermore to that, it's different than what other value managers do. So while you're waiting for something like a deep value play for that mean reversion, these names to turn around, it's something that can help supplement that exposure. So those are the toolkits we've seen, are the way that people approach CAPE in their overall toolkit.
All right. Thanks for that clarification. And you actually already answered my last question within that answer, because especially right now, like the question of valuation, right? Are we overvaluating the market? But as you mentioned, tech, AI, things are different now. So be interesting to see how all this pans out. Everybody, Jeffrey Sherman from Doubleline. Jeffrey, thank you so much for taking the time today. We hope you take care.
Yeah, thank you, Daniel. Thanks for having me.
All right, everyone. We'll see you next week with another episode of ETF Spotlight. Take care.